I believe, is one of the most eye-opening things, like what we're about to talk about. We're going to start to help you understand, hopefully within this episode, at least open your eyes a little bit, what to expect as far as variance, good luck, bad luck in trading, right? And we're going to use both statistics from James himself and also myself in my own trading, because we trade very different systems, very different time frames.
There's a big misconception, and we'll get into it, about you have to trade for a 2-to-1 risk-reward ratio to make money. I used to trade a system that actually had a 0.5 risk-reward ratio, meaning that I'm risk 100 to make 50, but because the win rate was higher, it actually turned over a lot better than some of my other systems that I used to trade when I was trading.
You maybe in your mind expect certain things, and maybe you think, oh, like it's very unlikely, that I'm going to lose 10 trades in a row. Even if you have a 90% win rate, it's possible to lose 50 trades in a row. It's very unlikely, but the chance is not zero. What's going on, guys? Welcome back to the Challenge Accepted podcast. James, as you can see, is in a different room setting today. He's on vacay, but he's still taking the time out for us to record this little episode for you. And I really think that this episode is going to be a fun one, because this, I believe, is one of the most eye-opening things, like what we're about to talk about. I think it's one of the most eye-opening things that, beginner and even intermediate traders really, I don't think most people understand this. It's the mathematical side of, taking into account variance and understanding equity curves. We're gonna take a look at this, right? Equity curves. We're gonna take a look at how math affects things. We're gonna run some Monte Carlo simulations, and the entire gist of this is, what can you expect from trading, right? Like, what is possible to happen given that you have a certain win rate, given that you have a certain RR, right? You maybe in your mind expect certain things, and maybe you think, oh, like it's very unlikely, that I'm going to lose 10 trades in a row. Even if you have a 90% win rate, it's possible to lose 50 trades in a row. It's very unlikely, but the chance is not zero. You'd probably be the most unlucky person on earth if it happened, but it's not impossible, right? So there's this concept called a non-zero chance. So this is what we're going to explore, because I think this is going to help you as a trader. When we get into this topic, it's going to help you as a trader understand how to deal with drawdowns, how to go through periods of time when, you're facing a losing streak, because those just happen. Like, it doesn't matter what your win rate, how good you are, those just happen. And I think one of the biggest things in trading is learning how to get yourself through that. Not avoiding it. Like, don't go searching for a system that, no drawdown system doesn't exist. Okay. If someone tells you there's a no drawdown system, they're scamming you. So we're going to get into this. We're going to start to help you understand, hopefully within this episode, at least open your eyes a little bit to what to expect as far as variance, good luck, bad luck in trading, right? And we're going to use both statistics from James himself and also myself in my own trading, because we trade very different systems, very different time frames. So you can start to understand and take a look at what potentially equity curves may look like, and potentially what drawdowns James might experience in his system, what kind of drawdowns I might experience in my system. And maybe you can then run those tests and run those numbers yourself and start to understand more based on your own statistics. So without further ado, let's get into the numbers. Let's take a look at some simulations, and we'll start to discuss this as we go on. So one of the things that I learned as a poker player is that we need to understand our equity curves, or the potential equity curves, very well, because it is a game of chance. It's very similar with trading. It's a game of chance. You are flipping a coin, right? Trading, whether you like it or not, every single individual trade is a coin flip. It doesn't matter how good of a trader you are. There is no trader that can guarantee that their next trade is going to be a winner. It's impossible.
It's
right?
impossible.
Like, it doesn't matter. There's no guarantee that your next trade is going to be a winner. What we do have, how edges play out, is over long term, right? Hundreds, if not thousands of trades, flipping that coin over and over again, right? So imagine, if you're flipping a coin, and it's 50-50, heads or tails, right? You get into this coin flip, there's no edge there because it's 50-50. Like, you can't win and you can't really lose by betting on either side. But with trading, you can have skewed odds. You can have maybe one side heads is 60%. And then maybe if you leverage on top of that, when you get heads, you if you bet $1 instead of winning $1 back, you maybe win $1.20. Given these scenarios, I would be betting on heads and flipping this coin as many times as I possibly could until my hands fell off of my body, because I would make so much money. Like the more I flip this coin, the more money I would make, right? That's kind of the idea that of what trading is. That's kind of what you can get into from a mathematical perspective. But I want to today get into something that can help you visualize things, help you take a look and say, hey, oh, this is actually how things can play out. We can go much, much deeper. And that's what we're about to do. All right,
so before we get into it, I know DY loves this topic, so this is going to be really, really cool to discuss. But I also want to chat about a few things. There's a few misconceptions in trading, which we'll show you. Don't take our word for it. Go and do the research yourself, but we'll show you actually live on stream equity simulators. There's a big misconception, and we'll get into it, about you have to trade for 2-to-1 risk-reward ratio to make money, and it's a bunch of BS. I used to trade a system that actually had a 0.5 risk-reward ratio, meaning that I would essentially risk 50 and risk 100 to make 50. But because the win rate was higher, it actually turned over a lot better than some of my other systems that I used to trade when I was trading more systematic type of way. But we'll get into it. Don't take my word for it. Go actually do the checking the stats for yourself.
Yeah, I mean, we're going to explore this. We're going to explore this today. And I think some of you guys are going to have your minds blown, because I don't think anyone that's never done a simulation like this will really understand. So we're going to jump into my computer now, and we're going to start talking some numbers, right? These are some stats that I've collected from my own trading. And let me just turn this notification off. I'm just getting these trading notifications.
Is notifications to buy China stock.
My trade alerts are going off. Right. So we're going to start off here. This is what you call a Monte Carlo simulator. Essentially, it takes the odds and probabilities, and it runs thousands of simulations for you to get an understanding of what the median, the best scenario, and the worst scenario looks like, right? So we can run some stats through. Like, I don't want to I think by looking at the stats, you're going to start to understand this a lot more. So we can start with James, right? So let's say we have $100,000 account, right? Which is, a lot of people are taking these 100K challenges. It's not insane to assume that. And what's your typical risk per trade, James?
Call it 1%, or you want to do dollar.
No, because a percent is good. Do you know your percentage of break-even trades?
No, I don't take break-even trades. I wish I did.
So yeah, if you don't have break-even trades, we'll just put it as 0.
I'm winning or losing. Yeah, I'm winning or losing.
Okay.
So my winning trade percent. Oh, that's percentage.
Yeah,
percentage. Trade. So my win rate is about 72%.
72%. And on average, how many trades do you take per month?
Per month, probably about 60.
60 trades a month. Yeah, and then we'll simulate this over the course of 4 years. And then what is your average risk to reward?
Average risk to reward ratio about 0.7.
Right. So based on these numbers,
69. Yep.
I like that better.
Yeah. I'm just thinking about stats now, actually. 0.69.
69. We're going to simulate the, so we can't do 2-digit decimal. So we'll just say 0.7, right? Okay. We're going to run this simulation. And this is a free tool, by the way. You guys can just Google Monte Carlo simulator trading. And you can take a look. We're going to take a look at the amount of variance that you can expect when trading with James's stats, right? If you're trading this exact system, you can take a look at how profitable this system is. Obviously, it's yielding great results. There's 3 tabs here, right? We're looking at the most possible line, which is this blue line on this equity curve that you see here. And that's the median line. That's the most likely scenario to happen after he's traded for 48 months with these stats, assuming these stats are applying across this whole system, right? This would obviously result in a phenomenal return, if he was risking 1% per trade. Now, there's something else that we're going to get into, because the maximum drawdown within this system that you can expect is a negative 7.3% drawdown, right? So you know that at some point in trading this system that you're going to draw down the account by 7.3%, risking 1% per trade. This is a benefit of trading a lower RR, higher win rate system, is you are less likely to, not less likely, but the drawdowns and the losing streaks that you experience are going to be less extreme. The lower your win rate, the more likely and the more extreme and the more painful your drawdown periods are going to be, simply because there is just a higher probability that you lose any given trade. Right? So you can take a look at some of these numbers. Maximum consecutive losses within this simulation, right? Maximum consecutive losses is 7, and max consecutive wins is 24, with an average win rate of 70.2%. But if you look at the worst case scenario, right? This is the worst case scenario, and this is something that can happen, right? This is something that can happen within the course of 48 months. We're looking at very, very big data here. Obviously, this still returned phenomenal, like after trading for 4 years, if on average he never stops trading 60 trades per month, and he compounds. Please understand, this is taking into account compounding over the course of 4 years, which is something that is very, very powerful as well. Okay, but we're not going to talk about compounding, but you'll see that on average, he has a lot of very positive months given these numbers, right? Even in the worst case scenario. Now, you could also look at the best case scenario, and the overall return is astronomical. But are you likely to achieve this? It's extremely unlikely, right? So if you take a look at these numbers, just based off of what James is trading, if we just reduced the time frame, right? If we reduce the time frame and we took a look at, let's say, 6 months, and we simulate the returns, max consecutive losses 3, maximum drawdown 3.3%, max consecutive wins 25, right? So you can start to see and understand over the course of 6 months, which is 360 trades, how this system can potentially perform. Best case, worst case, right? In the worst case scenario, negative 2.4% on a singular month. The more minute you look, the lower you look at the data and the sample size, the more volatile it potentially can be. That's usually what you see when you look at certain equity curves, and that's usually what you see when you run certain simulations, right? For example, if we took something that was completely break even, this is another example that I want to give you guys, is if you take something that's completely break even, right? Just absolutely break even. We know 50% win at a 1-to-1 risk reward. That should be a completely break even system. I mean, after fees, you would be losing, right? We know that this is something that should just net zero over a certain period of time. So if we simulate that over 48 months.
Also, DY, just also with the number of trades per month as well, is that sometimes I might get only 15 trades a month. So I think maybe even for that, I mean, I'm just looking at my stats again from this year. Probably also when I'm splitting positions up, closing half, it's probably more about, I would say maybe a trade a day. So maybe 25 trades a month.
So if we're okay, we can go back and run those numbers again. We'll take a look at the numbers again. But if we look at, for example, a completely break even, something that we know is break even. This is why I want to explore this, right? Let's look at a smaller sample size. Let's say 12 months.
Sure.
You can see that if you are completely break even, there's a chance that you're going to be down trading a completely break even system. There's a chance for you to be down negative 57.9% on the account, flipping a coin, which you shouldn't really lose. It should be break even. And there's also a chance that you're up 64% on the account, risking 1% per trade, and you're completely break even, right? This is what happens in any kind of game or of chance of variance. You will see that knowing the numbers are completely break even the most possible outcome here, it's saying that, in 2025, it was down negative 34% and then up 8% in 2026, right? Very close to break even here. But you could also experience these swings, right? The more closer to break even you are, the more volatile or, up and down your equity curve is going to experience. So everything that you take into account in trading, everything that you do in trading, you need to zoom out and take a look at the bigger picture. Because if you look at the stats of this coin flip, right, you look at the best possible scenario, max consecutive wins in this 2-year period was 11. So if you're just basing something off of your current streak, for example, right? If you look at your current streak of things and you say, hey, wow, like I've just won 8 trades in a row, that by no means that you're a profitable trader, because the sample size is extremely small. You could be flipping a coin and you could just be experiencing a very, very positive run. And even over the course of a year, you could have made 88%. And you're still not a winning trader.
Yep.
It's unlikely, but it's possible, right? That's just the math, right? You could also be completely break even and you could be down 40% on the year and you feel like shit. Or maybe you lost 10 trades in a row, right? And you feel like you're the worst trader on earth. That's the flip side of things, right? You feel like you're the worst trader on earth. And you're down in the dumps, but actually the reality of it is that you could just be a break-even trader. Small short-term variance, and this isn't even short-term. We're talking a period of 24 months trading 60 trades per month. All right, that's a relatively large sample size. Running good and running bad, like the variance can be huge. All right, so if we jump back and let's say we take a look at what was it, James said? 20 trades a month?
Yeah, so say 20
at 70 and 0.7.
Yep, 70 at 0.7 or and 72% win rate. So
if we take a look at, like, jump back in this equity curve, and we take a look, like, we'll just take a look at the best possible and the worst outcome, right? Like the best possible outcome after 2 years of trading, James will return 229% with a maximum drawdown of 6.4%. Right, like, and
that's
experience potentially max consecutive losses of 5%, 5 in a row.
Trades. Yep.
Again, if you don't understand the numbers here and you don't take a zoomed out view of things, if you just started trading the system, let's say you just started, right? Like you have a profitable system, you just started trading this, and you experience 5 losses in a row. How many of you are dumping the system and quitting right there and saying, nah, this is shit? Right? How many of you would have the confidence and the understanding to say, hey, like, I should actually continue? And remember, we're looking at the best case scenario here, which is we don't know when these 5 losses happen, right? The 5 losses could be the first 5 trades. And you would have given up, you would have stopped trading it and given up your 229% return.
Yeah.
Right. That's one of the things, that's one of the reasons why I want people to start understanding the numbers, right? If you look at the worst case scenario, return after 24 months of trading, 56%, right? Again, this is the worst equity curve that has been simulated now. If we re-simulate it, it'll be a slightly different, right? This is now the worst curve. Is you'll see that the curves are a little bit different. But you'll see that, like, in the worst case scenario, right, returned only 24% in a year and then 20% in the following year. What is the most possible? You'll see how big of a difference between these two data sets and these 2 years even are. A 25% return, 26% return versus an 80% return in the second year, that's huge. But it's the exact same system, the exact same odds, and the exact same edge. If you look at what's happening in 2025,
yep,
right? You think James is having a good time these 3 months?
No. Also, what Dio, I want you to go and have a look. So there's 2 things I want to point out. First one is I'm trading with a negative risk reward ratio. That my goal actually at the end of each month is, if I know I'm trading up my stats, which is currently what I'm this month and the past couple is what it's been at, I'm wanting to go at a 70% win rate at 0.7 RR, 0.69. That's my goals, to get a 0.7 RR at 70% or above win rate, right, to RR. But if you go and so that's the first one. So this shows you that you can make money. The way I'm trading makes money, right? And that's with a negative RR. That's what we wanted to show you. That's what I spoke about in the startups. The second thing is go change the risk per trade there, D1, and you see how that changes things. So let's just change that to 2 or 3% per trade, 2% a trade.
Let's go a little bit more extreme. Let's say 3%, because there's a lot of fucking degens out there, who think 3% risk is like, that's small. Like, that's okay.
Look how much more drawdown you'll have.
Maximum drawdown here in the most possible scenario is a 21.4%. And take into account, this is an extremely high win rate system. Okay. Max consecutive losses is 4. So over the course of 4 trades, risking 3%, you would see your account balance dip by 12% in 4 trades. Is that something that you can stomach? Right? Is that something that you can stomach? Because we'll get into some of these other stuff. We'll talk a little bit about like peak to value drawdowns after we talk about equity curves, just so you have a better understanding. But you'll see that in this equity curve, like in this simulation, his worst month, he drew down the account 13.8% if he was risking 3% per trade. Right?
Yep.
Obviously, the return percentage, the more you risk, the higher your percentage returns will be. I don't know who's risking 3% per trade. Like, this is assuming that he trades perfectly based on his stats, like that experiencing a negative 14% month doesn't affect his psychology or decision making in any way, that he's just completely robotic about it, on his A game, 24/7. Drawdowns don't affect him at all, right? Which, in my experience, I cannot do that. It's not possible for me. That's why I trade it more systematically, because I can go on tilt much easier than a lot of people, So like I know myself.
You, bro. Jeez.
I know myself, right? So there's a lot of these, the stats from month to month can vary, right? This is just based off of something that's, like your numbers, right? So I can share, kind of like my numbers based on my system that I'm currently trading, right? This is a combination of a bunch of data that I've collected over 342 trades, back-tested data on, I changed my entry criteria, tweaked it slightly, and I wanted to collect more data on it. I wanted to make things even more systematic than they were before. And we can run the numbers for this system. It's a little bit of a convoluted TP. There's like 3 different take profits. I'll just explain it a little bit. TP1 is at 2R. I take off 40%. And then at TP2, I take off another 40%. And then at TP3, I take off the final 20%. So it's 2R, 2.25R, and then 2.5R. Okay. I'm not going to get into the math of how that affects the average RR, but we're just going to say average RR after fees I found to be it's like 2.09 or something like this, but we'll just say 2. Like we'll lower it. We'll say 2. And we'll have the percentage of winning trades. You'll see that I take a lot of break evens here, right? 23% of trades are break even. And overall, 30% of trades win, and then 23% of trades are break even, and 46.9 are losses, right? So we'll go into this. This is, again, a very different way of trading than what James is doing, right? Firstly, I'm fully systematic. Secondly, I trade off higher timeframes. Thirdly, the take profit and the risk reward is very, very different. So we can take a look at what that equity curve will look like. So we'll plug in 23% break even, and then win rate 30%, right? So we'll say winning trades 30%, break even trades, what was it?
23. Yep.
23%, and then I'm risking like 0.5. That's generally what I risk over 24 months. So you can take a look at these equity curves right now, and you can see that over 24 months, right? The worst case scenario is I lost money. All right. Based on the exact stats that I'm trading, I could be losing money after 24 months. Now, if you zoom out, the most possible scenario, I lost for the first year, and then I made money on the second year, 27% return, which is obviously going to be very good. Oh wait, I average a lot more trades per month actually on this system. Let's just call it 40. because on average I have multiple trades per day. Maybe it's like 5 days per week. We'll just say that. That's one of the benefits of trading higher time frames, by the way, is like you may think that you get less trades, but you just watch more markets. Like my watch list is way bigger now that I'm entering on the 1 hour time frame.
I'm trading a lot. I'm only trading in the US indexes and Mag 7 stocks. You probably trading a lot more markets than me, right? Because you can.
And I actually end up getting now more trades than I did when I was just trading intraday. A lot of times when I was day trading, I wasn't getting that many trades. But if we take a look at these numbers, right, the most possible scenario, most possible outcome after trading 2 years, I would return 50.1% with a max drawdown of 7.9. But look at how many max consecutive losses I endure. I endure 14 consecutive losses in the most possible scenario. All right, that's a lot. I don't know how many people would take 14 losing trades in a row and continue trading the same system. Right? Like, I don't know how many people could do that. But at the end of the day, if you zoom out and you look at the years, right? Like 15%, 30% return, that's pretty good. You know, like if you're taking a much larger account, you're making a return on that. And then if you start to compound things, this is when things really start to get a little bit crazy, right? Like if you start to compound things, let's say not even over 48 months, let's say you do this over the course of 10 years. How many months is 10 years? 120 months. Right? Yeah, 120 months. Right? You'll start to be able to see some of these like long-term compounding results. Like I really urge you to play with this yourself. Like really go and take your stats, simulate it, start to understand, what the most likely outcome for you potentially is, and start to really understand how many consecutive losses is possible, best case scenarios, worst case scenarios. Play around with the numbers a little bit, right? Play around with what you're doing in here and start to understand your numbers in the long term, in the short term, 12 months, 24 months, what is possible to expect, right? And what is possible to achieve. Start to play with these, start to look at these different equity curves. This is something that we used to do in poker a lot, is start to really take a deep dive into what potential outcomes may be, so that when you're at the table, in poker, you're at the table, in trading, you're at the desk, right? So that when you're making decisions here, you don't let the short-term results dictate your actions, and hopefully it affects your psychology, your decision-making. Hopefully that impacts it a lot less, right? So if we're looking at, stats, and I start to understand these stats, myself fully, and I understand that I can go into periods of drawdown, I understand, what the most likely outcomes are, I'm much more likely to end up sticking with the system, right? If we take a look, that's the second thing that I want to take a look at, right? Like if we take a look at the a risk of ruin calculator. Now this goes into more the prop game, right? Because with the prop firms, you have max drawdowns, different parameters that we have to work with, the prop firm rules. All right, so if we were to take a 70% win rate with a 0.7 average RR, risking 1% per trade over the course of, and we'll just say 9% is a max drawdown, right? As the rule for props, yeah. Like over the course of 100 trades, you'll see that, okay, if I'm risking 1% per trade, the risk of ruin, the chances of me drawing down the account to 9% are 0.425, which is pretty low. It's not impossible, but it's pretty low. I would say below 1%, you're probably okay with taking this risk, right? What if you bumped it up to 2%? Your risk of ruin becomes 5.9%. That means out of every 100 times you try, 6% of the times you're going to blow the max drawdown of the account, right? The second number that I want you to take a look at is risk of peak to valley drawdown, which just means the likelihood of you experiencing a 9% drawdown overall anytime during the 100 trades. So not negative 9% from initial balance, but just a 9% drawdown overall, right? Like based on what James is trading, right? If he was risking 2% per trade over the course of 100 trades, he would definitely have a very high chance, almost a coin flip, of experiencing a 9% drawdown or more,
Especially when I'm tilting, then I'll probably have 90% of it.
So if James is trading this way, right, like, and he comes in and he says, hey, like I want to look at, let's change the max drawdown to 6%, right? And he was, because in our single phase accounts, right, the max drawdown is 6%. So if he was risking 2% per trade, right, his risk of ruin would be 14.3%, which is very big probability. Right. So he then has to make a decision of like, hey, do I want to risk more and keep the, like run the chances of blowing my account, or do I want to risk less and trade the account for longer? This is something that you're going to have to really try to decide for yourself, right? If we're looking at my system, if we discount the break evens, it's about a 39% win rate with an average RR of 2, and we're taking a 1% risk. If I risked 1%, my risk of ruin is 30.9%, meaning I'm extremely likely to draw down. Not extremely, but pretty likely to draw down the account by at least 6%, right? So this is not going to work for me. If I'm trading this way, I am not going to risk 1% per trade on a 6% max drawdown prop challenge. It's just way too likely. So maybe I'm looking at something like 0.5 or even 0.4, and this starts to come down and be more in the acceptable range of things happening. So you can make much more informed decisions when it comes to actually your risk management, especially when it comes to prop challenges. If you're trading your own account, like risk whatever the fuck you want. It's however much drawdown you can stomach, right? Like can you stomach your account going down by 30%? If you can, then risk big all you want, right? So by taking a look and understanding kind of the numbers behind, trading, we took a look at the Monte Carlo simulators, we took a look at the risk of ruin calculators. We start to understand how edges play out long term. We start to understand based on frequency of trading, based on risk, based on, RR, what likelihood certain things are to happen. Right. So I would know if I ran my numbers here, with a 39% win rate, average RR of 2, that, I would probably be risking less than 0.4% if I was on a 6% max drawdown plan. If I'm on a 9% max drawdown plan, maybe this would be okay, right? The chance of the risk of ruin is less than 1%. So if I just trade it theoretically, this is theory, guys. Execution is not perfect. Like we're not algorithms, we're not robots, right? Like this is in probably the best case scenario where you are able to execute very, very well. These are the numbers that you're looking at.
And also when you got no emotions clouding your judgment, when you don't have other, you know how it goes, bro, with the tilting. So yeah, this is in theory. It's a lot different in practice. Yep.
In practice, things can be a lot different, right? Like in practice, when you actually are on the markets trading, I think especially if you're trading discretionary, the swings can, be a little bit more volatile. And sometimes you can be trading outside of the parameters that you normally are or where your edge is, right? This is why I really don't do that. Like I'm much more comfortable being systematic because I feel like it forces me to trade a certain way. And I don't have to rely on my own psychology and my own like judgment. Basically what I'm saying is I don't trust myself at all to trade. So I need something that keeps me on track, right? That's just how I do personally. So if you're someone like James that trades discretionary, you'll know that, managing your psychology is probably even more important, like way more important than a systematic trader, because a systematic trader can be very black and white where I can say, hey, you just broke the rules. Like there was an entry, you didn't take it, or this wasn't an entry, you took a trade. Why did you take a trade? You don't have edge, right? Like it's just black or white. Whereas, when you're a discretionary trader, you make decisions based on certain hypothesis, right? Like based on, okay, cool, price is here. I've seen this happen before. I know that I have a certain play that can take advantage of that. But because you don't have a hard-coded rule set, right? Like we went through in last episode,
yes,
what James was talking about, his system. There's a lot of discretion and a lot of personal judgment involved in discretionary trading, right? So your results can fluctuate a lot more, right? We all want to be trading at 100% all the time. We wish we could all trade at 100% all the time. But that's just not the reality, right? So if you take a look at these numbers, right, if you're able to at least understand on a baseline, you have to understand this is a baseline. This is like, hey, if we live in a perfect mathematical world, which trading isn't, right? These are the numbers. So if I'm not performing at 100% all the time, the results probably aren't going to be that great. So the questions you should leave today are asking, should I be risking what I risk? Right. And I'm not just saying this on the high side, right? I'm saying like, maybe you risk too little. Maybe most people, I don't think most people watching this are going to be risking too little, but it's possible, right? Like, am I risking too little? Like, should I be upping my risk a little bit more, to secure more returns? Am I okay with the volatility that brings? Am I going to be able to stomach the larger drawdowns, right? Understanding the numbers helps you start to make decisions in a more informed manner. And I'm a big numbers guy, so I really love getting into stuff like this. And I think in the next episode, we're gonna let James take the lead because we're gonna look into data collection. And I would love to talk about how discretionary traders use data for their benefit. I would love to get into how James breaks down his trading numbers. How does he decide when to course correct? How does he decide, how does he figure out where the holes are, the leaks are that need to be plugged, right? Like, I think discretionary trading is really a lot more similar to poker than systematic trading is. Systematic is more like a very simplified way of doing that. So I would love to get into that in the next episode. We wanted to do this as like a little bit of a two-parter, talking about math, talking about the data, and this is just kind of the start, right? If you've watched this episode, I really urge you to go and take a look for yourself. Go and take a look at the numbers yourself. Go and take a look at your stats yourself. Plug them into these simulators and calculators. Think about how you can use numbers to your advantage. Right. So if you're looking at things in a certain way and you've experienced certain roadblocks, maybe this can help you get over the hump. Maybe you start to realize, oh shit, I'm risking too much. Or, oh shit, actually, like, why am I changing systems every time I lose 4 trades? We all know people that do that. I'm sure James knows. He runs a trading company. Like, he knows people that just like, ooh, I lost 3 trades. It's not working. Bro, it's a sample of 3.
So I'm excited for that in the next episode as well, because I'm actually busy going through some data myself, seeing, okay, maybe how I could maybe adjust the way that I take profits and stuff like that. So to help, my biggest work on is always trying to improve I need to get that risk reward ratio higher. I would like to get it closer to 1-to-1, but then I do know I'm going to give back some winning percentage. It's a give and take, right, in terms of win rate and risk reward ratio. So I think, I always enjoy this, and I was enjoying chatting to you always about this as well, DY, because I know you've got a big passion about this also with the poker background as well. So, and it always does make it very interesting.
Yeah, I think we'll start getting into the data a little bit more. We'll start talking about this more in the next episode. And, hopefully this kind of like realistic view into trading, this kind of, glimpse into the numbers helps you to understand. Because I know a lot of people, the worst thing I think you can do in trading is just like hop around different strategies. Because I did it at the beginning. Like, I really, really like it. I would take a few trades. I'd do some back tests and I'd be like, oh, cool. Like, this is working. And then I would trade it and I'd lose 3 trades. I'd be like, no, it's not working. Like, it's bad. And I did that for a while, which was, it really was a complete waste of my own time, honestly. And, I wish like I would have understood a lot better, like this. And I really should have, given my poker background, but it's still a different game, like,
Sure.
At the end of the day, when we step onto the charts and we want to make decisions, we want to be like our best self, right? Like, we want to make the best decisions possible, but that's not always possible. You should always prepare for the worst case scenario and understand the best case scenario, and understand that the probabilities lie most likely somewhere in between. And even if you have a 90% win rate, it's not impossible to lose 50 trades in a row. it's really not. Like, it's just a non-zero chance. Again, you'd be the most unlucky person on earth, but it could happen. And, you know, you could be profitable and you give up an edge, right? Like I think that's the biggest thing. It's like, if you have an edge, you go through a rough period, don't quit. And conversely, just because maybe you just started trading, you made 10 wins in a row, or you're trading some system, you know, like you made 10 wins in a row, don't get over the moon. Don't start being like, oh shit, like I got it, you know, like I'm going to risk 5% in my next trade. Don't do that. All right. Like, understand when it's good, understand how bad it can be. And when it's bad, understand how good it can be, and use numbers to your advantage in helping you understand how to navigate trading in the market. So I hope this episode was helpful for you guys, and we'll get into the part 2, dive deeper into the data in the next episode, and we'll let James take the lead on that one. I'm excited for that one, bro.
Yeah, no, likewise. Always enjoy these chats, but it makes me also think about my trading and how I can always improve. That's the point of trading, right? To be better every single day.
Yeah. Okay. We'll wrap this one up. Thank you guys for tuning in as always, and we'll catch you in the next episode.